Hey everyone, it's Phil Hall of West Fair Communications. Thanks for joining us today. If you were listening to our podcast, The West Fair Business Buzz, a week or so back, you may have remembered Dan Nuwash. He is the managing partner over at Finance for Thought. He was talking about taxes and other ways that companies can lower their expenses, lower their business taxes. We had such good feedback with that, we decided to bring Dan back and put him on camera. And here he is on the screen with me. Dan, thanks so much for joining us on today's show.
Of course, thanks for having me.
Well, Dan, on today's program, I want to talk about doing a financial checkup, because a lot of folks have been going through the past few months on pins and needles. Many people have lost their jobs. Others have been furloughed indefinitely. Most people have gotten a stimulus check, but $1,200 can only go so far. And same thing with unemployment benefits. And want to get a strategy going for people to get themselves back into better financial shape as the pandemic starts to wind down and the country begins to tiptoe to normalcy. First question I have is, how is it possible to save money in an environment like the one that we are in now and coming out of slowly?
Well, I would say first and foremost, always work with a professional when it comes to, even if you're a professional in that industry. I myself, I have other, my colleagues look at some of the work that I do for myself, or I get their input, because it's common for us, and I would say the vast majority of people have an emotional tie to their money.
Yeah.
And when you have an emotional tie to something, you are more likely to make bad decisions, right? When we're making decisions based off of emotion, it tends to cloud our judgment, and we use less logic and reasoning to do so. So the first thing I would say is always work with a professional, work with them to do a budget or a cash flow statement. I always encourage people on the individual level to look at your money the same way that a business looks at their money, right? So I like to call it me incorporated.
Okay.
And what that does is it makes you look at, one, your cash flow, right? Or which really for on an individual level referred to as a budget, right? So a cash flow statement, and also look at your assets, which businesses also look at, right? They have assets and liabilities. And then you want to look at your expenses, all right? And when you're looking at me incorporated, the most common answer that I get when me incorporated is running in the red, meaning you're spending more money than you're bringing in. The most common answer is always, well, I'm just not making enough money. Well, that's not how a business would ever operate, right? If one of my business clients ever came to me and said, oh, well, yeah, the problem is that we just need to bring in more revenue. All right, well, that's a lot easier said than done, one. And two, it almost always takes, to make money, you have to spend money normally, right? Whether that's through sales, a sales team, marketing material, that sort of thing. So I would say it's the best thing you can do is take a different look at how you are operating me incorporated, or what's really your personal finances. Don't look at it as the same way that, all right, I have money coming in, I have a budget. Look at it as a way that I need to make this entity profitable. And the vast majority of the time, I've never worked with anyone on the individual level or on the business level either, where we were able to look at their cash flow and make cuts and reduce those expenses. The reality is going to be something, and if me incorporated is running in the red, it's not because you're not making enough money.
Yeah. Where do you go to actually save money outside of putting it under your mattress? You could put it in a savings account, but the banks are charging almost nothing in the way of interest. What vehicles would you recommend for people who want to put money aside and save it and see it grow?
Well, I want to be clear that I'm not going to make a recommendation, because compliance would really come down on me if that was the case. But savings accounts are, I don't want to say they're a thing of the past, but they're kind of a thing of the less financially astute, right? A money market account operates almost the same as a savings account. There might be, a slightly longer time period to gain access to the money, but by that I mean 24 hours. I don't mean a week or 2 weeks. And it's going to depend on, what you're looking for. Are you looking for liquidity? If so, a money market's always a good option. You're going to get a slightly higher interest rate than you would with a standard savings account normally. It's still going to be liquid, and it's a safe investment as well. If you're looking to have something held for a longer period of time, and risk is you're more risk averse or you're less risk averse, with a regular brokerage account to invest some of your money, or working with an advisor to invest some of that money, but still maintain that liquidity, can always be attained. All right, but the key thing is to work with someone that doesn't have the emotional tie to your money. They have the professional tie to your money.
That makes perfect sense, and I didn't mean to put you on the spot with that one. A lot of folks around my age and a bit older are thinking about retirement, and a lot of us are thinking, I don't think we're going to be able to retire, considering how the things are in terms of the economy and expenses. Is it too late for somebody like me in their mid-50s to start planning properly for the financial aspects of retirement?
Absolutely not. Too late is always tomorrow, right? The reality is the more time you have to plan, the better the situation. And if you were working with a professional, they should have put you in a position where even if you still planned on retiring now or sometime soon, that you would still be in a good position to do so, right? If your retirement savings and funding and all that is invested for the long haul, as you get older, they should be pulling back that risk, right? And if you're younger and you're have a retirement account or investment account and it took a big hit now, it's nothing to freak out about, especially if you're not planning on touching that money for another 20, 30 years or so. If anything, now could be a good time to double down, right? The market doesn't fluctuate in a linear pattern, right? It fluctuates in a diagonally inverse pattern where it goes up and down, but for the past 50, 100 years or so, as long as we've been measuring the market, it's increased. So this is really a black swan event, right? Black swan is some sort of outside factor that's going to affect the market, right? So the 2008 meltdown wasn't a black swan because that was directly tied to the market, whereas now we had a pandemic. So it's just an outside event that's causing the market to take a dip, but it's not market related. So I think we're going to see a nice recovery. A lot of experts are anticipating a V-shaped recovery rather than the U-shaped recovery where it'd be slower. And I think that's a fair assumption.
Another question at the other end of the age spectrum. My pal Josh just became an uncle, and he was showing photos of his little niece, and baby, of course, is gorgeous and cute. But baby's going to be going to college someday. How do you start planning college savings, particularly for someone who just entered the world?
Well, I mean, there's several vehicles you can use. The 529 plan is going to be the most flexible vehicle off the bat. I mean, you can always do, a standard brokerage account or investment account. Some people use life insurance. I'm not going to be the guy that tells you a permanent life insurance plan is a great savings vehicle. I think insurance is first and foremost risk management. But 529 plans, and depending on the state you're in, for example, in New York, you get a deduction on your state income taxes if you're contributing to a 529 plan. The money grows tax-free on the federal side as well. So, and that's across the boards. Any state you're in, you'll be putting in after-tax dollars in most cases, right? So post-tax, but you'll be able to access that money, the growth of that money tax-free for education purposes. And it doesn't have to be just college or, higher education. It could be trade school. In some cases, even private schools, prep schools, college prep schools, community colleges as well. So you're going to have more flexibility than just a 4-year college degree at a university. You can use it for pretty much any sort of professional education. Even in some cases, if you are required to get some licensing. So for example, if you're a teacher and you have to get some licensing, you can use the money for that as well. And you can also change the beneficiary. So for example, I don't have children yet, but I have a 529 plan because I'm planning ahead of that.
Wow. So you can have a 529 plan without actually having a child who's going to be the beneficiary of it?
Correct. I mean, you can have the beneficiary can be just about anyone. I mean, you can't make the beneficiary, a pet or something along those lines, all right? There have been instances where that's happened. Somebody creates a pet as the heir to their trust. But for example, you can have a niece or a nephew, grandchild. Those are pretty common. So just because you don't have a child yet doesn't mean you can't start. And, if you're in a state where you get the deduction on the state income tax, then it can benefit you in that way as well.
I wouldn't use a 529 on my dog. He's an obedience school dropout.
Yeah.
He's really incorrigible. I wanted to go on to another topic in terms of refinancing. I've noticed over the past couple of weeks, there's been a real boom in refinancing. Homeowners tapping into their property's value. Do you recommend that at this particular time?
I mean, I would say refinancing as far as just creating some liquidity if you need if you need the money. I would say it really depends on what you need the money for. I always recommend first and foremost, the best starter home you can get is a multifamily, right? A 2, 3, or 4 family. And you can actually use a conventional mortgage to purchase up to a 4-family home. If you're a veteran, like myself, I'm a veteran. I've used the VA loan before. I used the VA loan to purchase a 3-family property. And I lived in that property for 3 years, expense free, because the rental income was covering all of my living expenses. And then I was building equity into an asset that I wasn't really paying for. So the best starter home is always going to be a single family. A multifamily. Single family homes, when you look at it, when you really look at a cash flow or a budget or a net worth statement, what you want to do is separate assets and liabilities. And I think in the accounting world, we look at those the wrong way, right? Because a asset is something that creates income, whereas single family homes tend to be a liability. Now you do have that situation where you can pull out some of the equity from your single family home, but if you're just using that just to pay the bills, you're really creating more of a liability down the road because you're now tapping into the equity. You might get a higher interest rate if you're refinancing. You might have to get more insurance on your homeowner's insurance, whatever it may be, if that property gets if that property has to be revalued. So there's risks in that instance, but I have worked with clients before where they've built up a lot of equity in a home. So we'll pull that equity out and put it into an asset that's going to generate them some income. For example, pulling equity out of one home to purchase a rental property. All right. And then you've done some risk management with that as well, because you'll have one mortgage, but you own 2 properties. And one of those properties is actually generating you an income. So it really is going to depend on what you're going to use that equity for. So I know that's not really a straightforward answer, but it's difficult to give those sometimes.
It's understandable, but also, I mean, I'm in Connecticut, you're in New York. We're both in states with very high property taxes. So you can't really get around that, can you?
Yeah, the only, and this is state dependent, but the only entities that don't pay property tax are nonprofits. So property tax is one of those things that's difficult to get around. I mean, you can, depending on the state you're in, you get a deduction on your federal taxes for it, right? But in states like, for example, in Long Island, the average property tax, I believe, is $14,000-$14,000.
Yeah.
Yeah. And we're talking about like a single family, like we're not a McMansion or anything, just a regular old home. And the SALT deduction, or the state and local tax deduction for the federal limit, is $10,000. So a lot of people in states with high state and local taxes, specifically property taxes, got hurt by the new tax bill in that sense. Might have benefited them other ways. But yeah, the property tax, it's one of those things that move if you can. There's some, yeah. And we are seeing that, right? The population in New York has actually been shrinking. And I don't think it's a coincidence that states with the highest cost of living
Mhm.
also have the highest state and local taxes.
Yeah.
But I would expect, especially after this, everything that's gone on in New York recently, I'd anticipate an exodus of and more so than it's been happening recently.
Yeah. I don't know if you could hear. Apparently, my landscaper decided to pave a bit of a noise. I'll mute this after I ask this next question for you. Is this a good time to start a business? A lot of people are worried about their jobs or they've lost their jobs and they're thinking, well, why should I be dependent on somebody else for my livelihood? I should be my own boss.
Yeah, I mean, I would say that there's never a perfect time to start a business. So now is probably the most perfect time. Um, you're never going to have an ideal time. Now's a great time. We're seeing a lot of businesses that are getting bought up. So, for example, I have a client that he owns several businesses. One of them specifically is in an exhibition company. So they do art shows and set up art, promotions and galleries and that sort of thing. Well, that industry obviously took a very big hit, but they're taking this as an opportunity to purchase a lot of those other businesses that are distressed. So when the markets, I think one of the key things I learned, or that was taught to me really, was that millionaires are made in an up market, but multimillionaires are made in a down market.
Got to unmute. He's still mowing the lawn
Yeah.
out. How is that? How are multimillionaires made in that way? That's an intriguing consideration.
Well, it's a contrarian view, right? Contrarian investors tend to be the investors that do the opposite of what other people are doing. The reality is when the market's down, as I mentioned earlier, it's really a buying opportunity, right? Things are cheaper now than they're going to be, and we're not just talking about the market, right? Gas has been cheaper. I was just looking at flights earlier. I was looking at a round trip flight to Florida. It was $75. Everything is cheaper in a down market. The issue might be liquidity, right? A lot of us don't have liquidity in a down market, but that contrarian mold is, what ends up happening in the up market is everybody loves putting their money into investments or a new business, or they when they have, or when they're feeling good about their assets, that's when people decide to take a little bit of risk. But you're purchasing at a premium in an up market with just about anything. Where in a down market, you're always purchasing at a discount. So you're going to make the real money in investing in a down market over that long haul by using that method to this basic principles, very basic principle that we've all heard at one point, right? Buy low, sell high.
I wish I had somebody like you back when I was in school. There isn't that much in the way of financial literacy lessons within the schools, because now the schools are closed and everyone is teaching their kids at home. Uh, for the parents out there who have young children or teenagers, how can they get started teaching them the basics of financial literacy?
Well, I would say, so what my parents did is we didn't have a whole lot of disposable income growing up. So if we wanted anything, we had to get a job. So me and all my siblings, we started working when we were 14, which was a legal working age in Texas, where I grew up. So having them get a job, forcing them also to then maybe save some of that money, which my parents also did. If I wanted any disposable income as a child, I had to earn it myself. And also creating that work ethic at a young age, I think, is important. But if you have a financial advisor, the financial advisors, they might normally charge you a fee or be paid commissions, but that doesn't mean that they just look at your money. You can call your financial advisor and say, hey, I want you to talk to my kid, even if your kid's young. I want you to talk to my kid about money. I think what's the gentleman's name that wrote Rich Dad Poor Dad? Robert Kiyosaki. I can't remember his name, but he makes a very good point about how we're not properly educated about money, because we don't view money as a medium of exchange. Rather, we view it as an asset. But the reality is the dollar now is just a medium of exchange. So really figuring out how it works is the key, and educating people, especially at a young age, on purchasing assets rather than liabilities is important, right? Assets being things that are going to help you make money, whereas liabilities are going to be things that just take it from you.
How does one find the right financial advisor? What advice would you give for somebody who's watching this video and saying, I like what this guy's saying, I'm going to find myself a financial advisor, but do you just do a Google search, or you ask your friends or colleagues? What's the best way to go about this?
Yeah, I mean, I would say one, referrals are always I would say vast majority of financial advisors that I know get their business through referrals. And that's because you're going to be talking about something very personal. So you don't want to just necessarily find someone off of Google or something along those lines. And it's nice to have someone that that is going to kind of give you their word for them, or give you their backing, and interview them. You don't have to go to just one. You can go see several financial advisors. They're normally not going to charge you a fee for an initial consultation. So go to several, because it's more than just, are they good at their job? You do want that personal comfort with them as well, because people are talking about individuals, when it comes to talking about money, it's the most personal topic for them. And people are literally they've done surveys that show people are more likely to talk about their sex life than they are their money. So you want to find someone that you're comfortable with.
Oh, I don't have much to talk about on either subject. I'm at a loss for words.
Yeah.
And we're actually at a loss for time. Run out of words. And if folks wanted to continue this conversation with you, Dan, how can they get in touch with you?
Well, the best way is always through my website, financeforthought.com. All of our contact information can be found on there. You can also follow me on social media. On Twitter, I'm at finance4thought. I'm on Instagram as well, Finance for Thought, and Dan Nuwash. And I have a very uncommon last name, Nuwash, Nuwash. There's not a whole lot of us in America, so we're pretty easy to find. So a Google search should turn us up.
And as luck would have it, as we come to the end of the episode, the landscaper finally turned off his lawnmower. It always works that way. Dan, thanks for being with us and giving such great advice. And folks, we'll see you again next week. Have a good one.
Thank you.